Ladies and gentlemen, let me ask you something straight out of the gate. What if the market is already screaming at us? But most people are too distracted to listen. Right now, while headlines shout optimism and social media celebrates every tiny rally, a quiet but dangerous signal has appeared on the charts. It's called the shooting star candle. And history tells us this is not a symbol of hope, it's a warning. A warning that often shows up right before confidence turns into panic. A shooting star candle looks harmless to the untrained eye. One day of trading, a long upper wick. A small body, nothing dramatic. But in reality, it represents something powerful. Buyers push prices higher with excitement and belief, only to lose control before the day ended. Sellers stepped in, quietly but decisively, forcing prices back down. That candle is the market admitting weakness while pretending to be strong. It's optimism getting rejected in real time. This is where most investors make their biggest mistake. They chase the illusion. They hear analysts saying, "This pullback is healthy," or "This time is different." But markets don't crash because of bad news. They crash because confidence breaks. And confidence usually breaks after moments like this, when prices try to go higher and fail. The shooting star is not fear, it's denial. It's the calm before reality hits. Think about past market tops. Over and over again, the same story repeats. Euphoria peaks, risk feels invisible, leverage grows, and then suddenly, the chart prints a warning that few respect. A shooting star forms near resistance, near all-time highs, when everyone believes the upside is guaranteed. That's not coincidence. That's psychology. That's human behavior exposed on a candlestick chart. But here's the deeper truth most people won't tell you. This moment is not just about markets, it's about mindset. Smart money doesn't move on emotions, it moves on signals. While the crowd celebrates, professionals protect. While the noise gets louder, the real players get quieter. They reduce exposure, they raise cash, they prepare. Not because they are scared, but because they are disciplined. In economic terms, a shooting star candle represents a critical moment where demand reaches exhaustion at elevated price levels. Prices rise aggressively during the trading session, driven by optimism, momentum strategies, and the belief that higher valuations are justified. However, the failure to maintain those gains by the close reveals a deeper imbalance. The market briefly explored higher prices and rejected them, signaling that the pool of willing buyers at those levels has largely been depleted. This is not random volatility. It is a visible breakdown in the demand curve at the margin. What makes this signal especially powerful is where it tends to appear. Shooting star candles most often form near resistance zones after extended rallies or when asset prices are already stretched relative to historical norms. At this stage, participation is no longer driven by fundamental value discovery, but by expectation and extrapolation. Buyers are no longer asking whether an asset is fairly priced, but whether someone else will pay more tomorrow. When that belief fails to translate into sustained price acceptance, the market exposes the limits of speculative demand. Here is the hook most investors miss. Markets do not turn when fear is visible, they turn when confidence quietly peaks. A shooting star captures that exact psychological moment. Enthusiasm pushes prices upward early in the session, reinforcing bullish narratives and triggering breakout trades. Yet as the day progresses, selling pressure emerges without any obvious catalyst. That silent reversal is the market's way of revealing that optimism has outrun economic reality. Demand did not disappear overnight, it was already fully consumed. From a macro perspective, this exhaustion is often reinforced by liquidity conditions. When monetary support is tightening, real yields are rising, or credit conditions are becoming less accommodative, the capacity for buyers to absorb higher prices diminishes. The shooting star reflects this constraint visually. It shows that even with favorable sentiment, the financial system cannot sustain higher valuations without fresh liquidity or stronger income growth to justify them. This moment is dangerous precisely because it feels insignificant. One candle, one session, easily dismissed as noise, yet in aggregate market behavior. These signals mark the transition from expansion to vulnerability. Once demand is exhausted, price stability becomes dependent on continued confidence rather than actual buying power. That is an unstable equilibrium. Any external shock, policy shift, or earnings disappointment can then trigger disproportionate downside, not because conditions suddenly worsen, but because the market had already lost its structural support. The real warning embedded in a shooting star is not about timing a crash. It is about recognizing when upside has become fragile. It is the point where momentum no longer reflects strength but strain. When demand exhaustion appears at the top, the question is no longer how high prices can go, but how quickly confidence can unwind. In market economics, price is the most honest messenger of power. A shooting star candle captures the precise moment when that power begins to shift. Early in the session, buyers appear firmly in control, pushing prices higher with conviction. Momentum traders, algorithmic systems, and retail participants respond to the upside movement, reinforcing the belief that demand remains dominant. But as prices approach elevated levels, selling pressure quietly emerges. By the close, the market has erased most of the gains, revealing that sellers were not only present, they were waiting. This price rejection is not emotional selling, it is strategic distribution. Sellers step in where prices no longer reflect acceptable risk-reward conditions. From an economic standpoint, this indicates that supply elasticity has increased at higher price levels. As valuations rise, more holders become willing to sell, while fewer buyers are willing or able to pay the premium. The result is a failed attempt at higher price acceptance, a clear sign that the balance of power is no longer skewed toward demand. Here is the hook that separates surface level chart reading from real market understanding. The most important shifts in markets happen before headlines change. The shooting star is a structural signal, not a narrative one. Nothing dramatic needs to occur for this transition to begin. No earnings miss, no policy announcement, no geopolitical shock. The market itself reveals the shift by rejecting higher prices in real time. This is how control changes hands, quietly, efficiently, and without warning. Psychologically, this moment is deceptive. The majority of participants focus on the fact that prices were higher during the session, not on where they closed. That misplaced focus fuels false confidence. But professionals watch the close because the close reflects consensus. When sellers force prices down despite intraday strength, they demonstrate dominance. They are not reacting, they are asserting control. Economically, this transition has cascading effects. Once sellers establish authority at higher levels, future rallies face increased resistance. Buyers become cautious, position sizes shrink, and marginal demand weakens further. Liquidity thins on the upside, making subsequent declines sharper and faster. What looks like a single failed candle becomes a feedback loop where supply repeatedly overwhelms demand. The deeper implication is that market leadership has changed. Buyers are no longer setting prices, they are responding to them. That is a fundamental shift in market structure. When supply dictates price movement, volatility expands and downside risk accelerates. The shooting star is not just a pattern, it is evidence that the market has tested optimism and found it insufficient. At that point, price no longer rises because it should, but only if sellers allow it. Markets rarely collapse because of bad news, they collapse because belief stops working. By the time negative headlines appear, the real damage is often already done. Confidence is the invisible fuel of every bull market, and when it reaches saturation, even strong narratives lose their power. A shooting star candle reflects this exact psychological breaking point. Prices move higher not because new value has been created, but because participants expect others to keep buying. When that expectation fails at the close, the market quietly signals that confidence has peaked. Here is the hook most people overlook: markets do not need fear to fall, they only need disbelief. During late stage rallies, optimism becomes consensus, and consensus becomes fragile. Everyone who wanted to buy has already bought. At that stage, price gains depend on continued faith, not fresh demand. The shooting star exposes this condition perfectly. Buyers push upward early in the session, confident the trend will protect them, yet by the end of the day, that confidence is challenged without any external trigger. From an economic standpoint, this reflects expectation saturation. Asset prices incorporate future growth, policy support, and earnings expansion long before they materialize. When expectations are fully priced in, additional upside requires increasingly unrealistic assumptions. The shooting star marks the moment when those assumptions are tested and rejected. Not publicly, not loudly, but through price behavior that contradicts the dominant story. This is why major market tops feel calm. Volatility is low, sentiment surveys are optimistic, and analysts explain away every warning sign. But beneath the surface, confidence is no longer expanding, it is recycling. Money rotates rather than grows. Participants begin to hesitate at higher prices, and that hesitation shows up as rejection on the chart. The shooting star is the visual footprint of that hesitation. The danger lies in misinterpreting stability as strength. When markets stop responding positively to good news or strong momentum, it is not resilience, it is exhaustion. Confidence has reached a level where it can no longer lift prices. At that point, even neutral events can trigger outsized reactions. Not because the news is bad, but because belief was already stretched thin. This is how turning points form without drama. The crowd is still optimistic, yet price no longer confirms it. That divergence is critical. Economics teaches us that systems break at extremes, not averages. When confidence becomes universal, it loses its marginal impact. The shooting star captures the instant when the market admits, silently, that belief alone is no longer enough to sustain higher prices. Leverage changes the speed and severity of market outcomes. In periods of strong performance and low volatility, borrowing increases quietly across the system. Margin debt rises, derivative exposure expands, and risk appears manageable because prices keep moving higher. A shooting star candle forming in this environment is not just a technical signal, it is a stress test. It shows what happens when leveraged positions attempt to push prices higher and fail. That failure is the first crack in a structure built on borrowed confidence. Here is the hook most investors underestimate: leverage does not need a crash to become dangerous. It only needs a failed breakout. When prices cannot hold new highs, leveraged participants are immediately exposed. Their positions are designed for continuation, not hesitation. The moment price stalls or reverses, risk metrics deteriorate rapidly. What looked like controlled exposure turns into forced decision-making. Economically, leverage introduces nonlinearity. Small price declines can produce disproportionately large effects. A 1 or 2% move lower may trigger margin calls, volatility adjustments, or algorithmic de-risking. When a shooting star appears after a leveraged advance, it signals that the system is vulnerable to cascading pressure. Selling is no longer optional, it becomes mechanical. This is how downside accelerates without warning. The market often misreads this phase as a healthy pullback. That interpretation ignores the structure underneath. In leveraged environments, liquidity on the way up is abundant, but liquidity on the way down evaporates. Once prices begin to slip, buyers step back, spreads widen, and selling pressure compounds. The shooting star marks the moment when the market tests higher prices and discovers there is no depth to support them. From a behavioral perspective, leverage amplifies denial. Participants cling to positions because exiting confirms risk. They wait for a rebound that never comes. As prices drift lower, forced exits replace voluntary ones. This transition is critical. Markets do not fall because everyone panics at once. They fall because leverage removes choice. The shooting star is the early signal that this process has begun. The real danger is timing blindness. Investors focus on fundamentals and assume they have time. But leveraged markets do not unwind gradually. They unwind when price invalidates assumptions. A failed breakout does exactly that. It challenges the belief that momentum will protect positions. Once that belief breaks, the unwind can be swift and disorderly. This is why shooting star candles near highs deserve serious attention in leveraged conditions. They are not predicting collapse, they are revealing fragility. They show that upside requires increasing effort, while downside requires only a small push. In that imbalance lies the true risk, not in how much prices have risen, but in how quickly leverage can turn hesitation into forced liquidation. In financial markets, the most important moves are often made quietly. While headlines focus on price targets and bold predictions, professional investors are watching something very different: risk signals. A shooting star candle does not trigger panic among experienced participants, it triggers discipline. It signals that the market has attempted to move higher and failed, and that failure demands respect. Smart money is not trying to predict the next headline. It is focused on preserving capital when conditions shift. Here is the hook: most retail investors never hear institutions, do not need certainty to act. They only need asymmetry. When upside potential becomes limited and downside risk expands, exposure is reduced regardless of how compelling the narrative sounds. The shooting star provides that asymmetry visually. It tells professionals that reward is shrinking while risk is quietly growing. That is enough to justify defensive action. From an economic standpoint, this behavior reflects rational portfolio management rather than fear. Capital is reallocated, not liquidated impulsively. Exposure to highly correlated assets is trimmed. Cash levels increase. Hedging activity rises. This process often begins before volatility appears in the broader market. which is why the public rarely notices it in real time. The absence of drama is precisely what makes it effective. Smart money also understands liquidity dynamics. When markets are rising, liquidity is abundant. When markets hesitate near highs, liquidity becomes selective. A shooting star signals that selling pressure exists at higher prices, meaning future rallies may face resistance. Professionals respond by positioning ahead of that reality. They do not wait for confirmation in the form of a sharp decline, because by then liquidity has already vanished. Behavioral discipline plays a central role here. Institutional investors are not emotionally attached to price levels. They are attached to process. When a signal contradicts their thesis, they adapt. This flexibility is a competitive advantage. While the crowd debates whether a pullback is normal, smart money is already adjusting risk exposure based on probability, not hope. Another critical element is time horizon. Professionals think in terms of cycles, not sessions. A single shooting star does not end a bull market, but it can mark the beginning of a transition phase. During these phases, returns become uneven, drawdowns increase, and capital preservation becomes more important than aggressive growth. Smart money shifts accordingly, often rotating into defensive assets or reducing leverage rather than exiting entirely. The key insight is this: markets reward those who act before certainty arrives. By the time risk is obvious, it is already priced in. The shooting star is valuable because it appears early, when action is still possible. It is not about being bearish, it is about being prepared. In that preparation lies the difference between surviving volatility and being consumed by it. Financial markets do not merely reflect the economy, they anticipate it. Prices move ahead of data, earnings, and policy changes because markets are forward-looking systems driven by expectations. When a shooting star appears at elevated price levels, it often signals that those expectations are beginning to fracture. The market is no longer confidently pricing in future growth, liquidity, or stability. Instead, it is hesitating, and that hesitation is often the first step in a broader transmission of stress. Here is the hook that changes how this signal should be viewed. Economic stress rarely starts in the economy itself, it starts in financial confidence. Credit, investment, and consumption all depend on stable asset values. When markets reject higher prices, risk appetite begins to contract. This contraction may be invisible at first, but its effects compound over time. The shooting star marks the moment when that contraction begins. From an economic transmission perspective, asset prices act as collateral. Rising markets support lending, risk taking, and expansion. When price momentum stalls near highs, financial conditions subtly tighten. Lenders become cautious, spreads begin to widen, and capital becomes more selective. None of this shows up immediately in economic reports, yet it directly affects decision-making across the system. The shooting star captures this shift before it becomes measurable. As confidence weakens, corporate behavior changes. Firms delay investment, slow hiring, and protect cash flows. Households become more cautious as portfolio values stabilize or decline. These adjustments are rational responses to changing financial signals, not reactions to bad news. Markets lead and the economy follows. The shooting star is often present at the point where that leadership turns from expansionary to defensive. The danger lies in ignoring early signals because they do not align with current data. Economic indicators are backward-looking by design. By the time they deteriorate, markets have often already repriced risk. A shooting star challenges the assumption that strong data guarantees continued market strength. It suggests that future conditions may be less supportive than current narratives imply. This is why such signals matter beyond trading. They reflect the health of financial transmission mechanisms. When markets can no longer sustain higher prices despite optimism, the system becomes sensitive to shocks. Liquidity dries up faster, volatility increases, and confidence erodes unevenly. Small disruptions begin to have outsized effects. The most important insight is this: markets whisper before economies scream. The shooting star is a whisper. It does not announce a crisis, but it questions stability. Those who understand this relationship do not wait for confirmation from headlines or reports. They recognize that when markets hesitate at the top, the future is already being rewritten, quietly, efficiently, and ahead of everyone else. So ask yourself honestly, are you reacting to headlines? Or are you reading the message behind the price? Are you chasing comfort? Or are you respecting risk? The shooting star candle doesn't guarantee a crash, but it demands awareness. It demands humility. It reminds us that markets don't reward hope, they reward preparation. Thank you.